Good evening, everyone. Thank you for being here today. Before we start, we would like to introduce you the Politecnico di Milano student research team.
Samuele Gaboli,
Fabio Palumbo,
Lidia Palladino,
Riccardo Musetti,
and Luca Professione. We're going to talk about YOOX. YOOX is a global internet retailer of luxury products. The success of this company is mirrored by its strong stock performance. YOOX stock price grew sixfold in the last 4 years. The company was founded in 2000 and currently operates two different businesses, the so-called multi-brand and monobrand business. Within the multi-brand business, YOOX manages three proprietary websites. YOOX.com, which sells end-of-season luxury products, still generates most of this business revenues. In the meanwhile, YOOX is also a service provider. Within the monobrand business, it helps luxury brands in building and managing their own online stores, providing them with its IT and logistic platforms. Currently, YOOX manages 37 online stores for luxury brands. Contracts are 3 to 5 years long, and the company earns a percentage fee on the online store sales. In 2012, YOOX entered a joint venture agreement with Kering Group and will manage the online stores of all of Kering's luxury brands, except for Gucci. But now, let's get to the point. Our recommendation is a sell, with a potential downside of 22.6% to December 2014. We believe this is definitely a good company, but a bad stock. After last year's stock price 3-digit growth, it's time to take profit on YOOX. Today's price simply reflects too optimistic expectations, as we're now going to show you.
Our first step is an analysis of the online luxury market and an estimate of its long-term growth potential. Online luxury market weighs today only 3.5% of the whole luxury market. This percentage is by far lower than the level achieved by other product categories. For instance, the apparel sector shows today a 19% of online penetration. In order to further highlight this opportunity, we show that in the most mature e-commerce market, the US one, luxury department stores have already achieved a 16% of online penetration. Through a statistical S-curve interpolation, we estimated a long-term penetration target of 12% by 2020, 5 times today's market size, 43.2 billion euros in our base case scenario. Such strong market expansion should provide YOOX a lot of opportunities to consolidate its leadership position, but at the same time, this growth could attract an increasing number of new competitors. As a second step in our valuation process, we deeply analyzed the multi and the monobrand business in their competitive positioning.
YOOX is the only group that manages mono and multi-brand business at the same time, exploiting important benefits from synergies and cross-fertilization. We considered as YOOX's closest competitors only e-commerce company in luxury niche. However, the competitive environment is continuously evolving. In fact, big e-commerce players like Amazon are not YOOX's direct competitor today, but we don't exclude their entry in this growing niche in the future. We did a portfolio analysis of YOOX's competitive positioning. This shows a lower sustainability of monobrand business. Starting from the point of weakness of monobrand, where YOOX is a service provider, we see important threats. In fact, this business is characterized by 30% growth, 20% EBITDA margin, and almost zero capital employed. This will certainly attract the competition and will incentivize luxury brands to internalize online activities. The result will be a squeeze on YOOX profitability in long term and a price pressure at the contract renewal. On the other hand, we see multi-brand business more defendable. However, we found 2 points of important weakness. The first is the low rating of YOOX mobile application, a more and more relevant factor considering the increasing importance of mobile commerce. The second is the need to increase investment in marketing to keep up YOOX.com brand awareness in the long term. Now, the third step in our process consists in giving a quantitative valuation of market and competitive positioning.
Before we focus on the long-term potential, let's start to analyze the success of the company in its early years. Group sales have grown with a 37% CAGR from 2007 to 2013. After 95 million euros capital raise at the IPO in 2010, the company has always managed investment and growth has remained in a net cash position. After the 2009 peak, return on invested capital went down to 12% in 2013. This was mainly driven by the D&A increase following the spike in investment for future growth. Moreover, YOOX suffered an EBITDA margin decline in the multi-brand business due to an increase in competition. Now, it's time to put into numbers our market and competitive analysis. We have set our long-term assumptions on three key factors. First, online luxury penetration. Second, market share. And third, long-term operating margin. Focusing on the first point, our base case assumptions start from estimating a 2020 online luxury market penetration of 12%, equal to a 43 billion euros market. Regarding the second point, we kept stable market share both in mono and in multi-brand business. Under this bullish assumption, we estimated a 25% sales CAGR from 2013 to 2020, which will lead YOOX to generate 2.2 billion euros in revenues. Our long-term assumptions on EBITDA margin reflect the different competitive strengths of the two businesses. For the multi-brand business, we have optimistically estimated custom margins. Given the monobrand business threats, we lower EBITDA margin from 20 to 12%. This is a more normal value for a service provider. Moreover, we have modeled joint venture with Kering separately. Our main assumption is on the profitability level. We assume a long-term net income margin of 10%, in line with the average of luxury companies.
In order to account for the high volatility of long-term scenarios, we implemented a discrete event simulation. Here, we show for each variable the values and the related probabilities for our worst, base, and best case. Combining these values, we created 162 possible scenarios. Our probability-adjusted DCF valuation results in a target price of 23 euros per share, far below today's market price. Furthermore, considering the distribution, we can infer that an investor at today's stock price will have an upside only in the best 19% of scenarios. For our valuation, we used a WACC equal to the cost of equity till 2020, as the company will remain in a net cash position. We decided to use a levered WACC only for the terminal value, in order to embed, at least partly, the potential value creation from a more balanced financial structure. As a sanity check, we implemented a relative analysis using both trading and M&A multiples. The resulting valuation are still lower than today's market price. Here, we represented different factors of risk according to their likelihood and impact. From a strategic point of view, increasing competition and failure in upgrading technological infrastructure are the main factors of risk. From a financial point of view, we argue that YOOX is not affected by severe risk factor. Last, from an operative point of view, the major factors of risk are related to the logistic platform, privacy threats, and most important, HR retention. Using YOOX data about early churn, we calculated that the company had to hire more than 200 new employees in 2012. YOOX has to create almost a new company every year. As a risk to our recommendation, we consider the possibility for YOOX to create a private label business. Using Black-Scholes theory, we calculated that this real option could be worth up to 2.7 euros per share. Even if we did consider this value in our target price, this would not have changed our recommendation to sell the stock.
A good company, an exploding market, some competitive threats, and the current price already discounts only the best future scenarios, even under bullish assumptions. We hope we have been able to explain you the reasoning behind our sell recommendation. Thank you for your attention, and we are glad to answer any question you may have.